Chairman of HDFC, Deepak Parekh, today gave an interview to my colleague Devna Vora and spoke about the larger macro picture of the economy. And he spoke about the usual suspects, weak GDP growth, inflation, interest rates, and also about corporate investment climate. Throughout the interview, we got the sense that he is optimistic about a revival and the government's new resolve, as he calls it. He has a snippet of that interaction.
Well, the numbers don't look good at the moment, whether it's GDP growth, inflation is still uncomfortably high, fiscal deficit. You, of course, know what the problems are. So where are we at right now as an economy?
Well, I think there's a general consensus that the Indian economy has bottomed out. So there's only one way to go. So I am reasonably optimistic for 2013. If you see the GDP growth rate, this is the lowest growth rate. Financial year 13, we'll have the lowest growth rate in a decade, 5.5, 5.6. But if you look at next year, I'm very positive that we'll grow at 6, 6.5. We won't go to 8 or 9, but at least the growth will be there. And there are a number of reasons. We still have fundamental problems in the economy, as you mentioned, high fiscal deficit, high current account deficit, infrastructure bottlenecks. And capital spending is not happening. Companies are not investing in plant and machinery, in capital spending. That investment cycle must start. So these fundamental problems remain. Despite that, I think there's a lot going on. And with the reforms the government has announced over the last few months, the parliament functioned successfully, albeit for a small period of time. So, some bills have been passed. So I'm reasonably positive that 2013 will be a much better year than 2012.
What about your outlook for the rupee? Also the FII sentiment towards the stock market?
See, I am a bit puzzled on the rupee depreciation. Most indicators are, first of all, when it is exports are slowing down, so there's a big trade deficit, and exports are slowing down, so rupee has to become weak. One reason. Overall, global sentiments are poor, weak. Uncertainty is enormous. So again, currencies will be weak, and emerging economies' currency like ours could be weak. But if you look on the other side, this is the best year for FII inflows. We've got 23 billion this calendar year. 23 billion net. Last calendar year in 2011, there was an outflow of FIIs. If you take NRI remittances, we've got $75 billion of NRI remittances compared to 64 last year. IT, BPO income has gone. So if you look at, this government, RBI has set up limits for corporate debt, FII corporate debt, FII debt for GSEC and FII debt for infrastructure. Again, these, at least the corporate debt and GSEC are fully utilized, so 25 billion each. That money has come in. So huge amount of foreign exchange has come in. I know the exports are slowing down, but it's the perception that is creating the fall in rupee. I think the other reason is the foreign exchange traders are aware that our Reserve Bank is not going to keep supporting the rupee by using dollars, the reserves that we have accumulated in a hard way. So the traders, the punters feel that we are not going to support rupee, so let it have a free fall. So there is a little bit of an anomaly. There are enough justification for rupee to be stable. I wouldn't say appreciate, but not go down like the way it has gone down.
India's #1 news app just got even better. Download NDTV's new app. Fully optimized for retina display. Full screen view. Faster response time. And Sudoku. NDTV's new iPad app. Download now.